Welcome to American Century Investments Podcast. American Century has been helping people reach important financial goals for over 60 years. This podcast provides us an opportunity to share our insights and expertise to inform individuals about topics to assist them in reaching their financial goals. This is Phil Hatterman with Al Chingren from American Century. Al, today we're talking about health savings accounts, which is often referred to in the industry as an HSA, and I think maybe we use it so much that people who aren't in the industry or aren't in healthcare don't know what an HSA is.
Yeah, and I think it gets confused as well with the predecessor of this type of account, which was an FSA, a flexible spending account that was affiliated with healthcare as well. But a health savings account is a personal savings account with some tax advantages, but the money must be used for only qualified healthcare expenses.
So who can have an HSA?
Well, you have to be enrolled in an HDHP, which is a high deductible health plan, and according to federal guidelines, they establish the limits, minimum deductibles on that, maximum out of pockets, or guidelines that are adjusted every year. But you have to be covered on that type of a plan on the first day of the month. You also cannot be covered by any other non-HDHP plan, with a few exceptions. So there's certain plans that may be limited in coverage, and we'll think in terms of, if you have a dental plan or a vision plan or maybe a disability plan, that probably is not going to prevent you from having this health savings account. You also cannot be enrolled in Medicare. So once you hit age 65, you're enrolled in Medicare, you're no longer eligible to contribute to a health savings account. And you also cannot be claimed as a dependent on someone else's tax return. So those are the qualifiers to determine who is eligible. It's not a mandatory account. You get to decide whether or not you want to participate, whether or not you want to open up a health savings account, and how much you want to put in.
So what are the factors one should consider in determining whether or not, assuming they're eligible, they should have an HSA?
Well, I think it all really comes down to out-of-pocket expenses. And clearly, if you're participating in a high-deductible health plan, there are some expenses that you'll pay on the front end. So this is a way to take pre-tax contributions, similar to the kind that you put into your 401k plan. And it's made through payroll deposits. And again, it could be subject to state tax income, depending on which states you live in. But there's a tax advantage to contributing to these type of plans. And so you can use that money then again for that long qualified list of health expenses to pay for that. The other thing is that the withdrawals, then when you pull them out, unlike an IRA account or a 401k plan, where when you take money out of those, they become taxable. If you use this money to pay for health expenses, qualified medical expenses, then you're not going to be subject to federal income tax, and most cases, not even state income tax, so tax-free withdrawals. The other piece of that is that if you leave money in this plan, so remember I said that it's not like the flexible spending accounts where you had to use it all up every year. This one allows you to maintain that account and keep money in it. In fact, you don't have to use it. You can just save it for some point down the road. So if you're in, for retirement, for example, so your earnings then become tax-free as well. So it gives you the ability to accumulate dollars to pay for future health expenses. And the other thing about these types of accounts is that it's portable, which means that you can transfer it into another HSA account. It doesn't have to stay with the one you originally started with. That may happen if you change jobs and you have a different plan and you have a different HSA provider. You can consolidate those accounts into the current one.
Sounds like an HSA is probably a good idea for a lot of people. There's tax advantages, and even though you're limited to medical expenses, eventually we're all going to have medical expenses. What are the disadvantages of an HSA?
Well, I think you look at it in terms of, in order to be able to use an HSA, you have to participate in a high deductible plan. So that requirement alone potentially could be a disadvantage. So you'd have to look at what's the cost associated with that type of a plan. While typically the premiums are less for that type of a plan, you're going to be paying for a higher deductible amount, maybe a higher out-of-pockets as well. And again, those things are established by federal guidelines, but it also then whatever provider you're with. So you'll have to evaluate that type of a plan. There are taxes and penalties if you use those monies to pay for non-qualified expenses before you turn 65. And I'll explain that a little bit in a minute. You'll owe taxes on the money plus a 20% penalty, again, prior to 65. After age 65, you'll owe taxes, but not the penalty. Right?
Okay.
And of course, there's fees associated with this type of account, as there are with all qualified plan accounts or any type of an investment account. There's typically fees. It could be monthly maintenance fees or per transaction fee, but it's going to depend on who's the provider for that type of an account. So you're going to have to check to see what types of fees. Sometimes the fees are waived if you have a minimum balance, but again, every provider could be a little bit different.
So when you mention fees, lots of things that seem like a good idea. Once you start drilling down, you find out there's this fee, there's that fee. What are some more of the fees that might be a part of an HSA?
Yeah, I think you can think of it in terms of those typical qualified plans. There's sometimes a setup fee. Sometimes there's an annual fee. Could be even a monthly maintenance fee that applies. There's also potentially additional fees depending on the type of account it is. If you have checks associated with this kind of account, you're paying for those medical expenses via checks, there's probably a check printing fee. If it's an online banking fee, potentially, if the investments that you utilize within that plan may be subject to some fees as well. So additional fees, depending on the type of an account you have, depending on the type of investments within the account. But it's important that you evaluate all those fees before you make a decision, because the cost of the plan is certainly an offset to the tax advantages of the plan. So long-term, probably an advantage. Short-term, maybe additional fees that apply.
How much can you contribute to an HSA each year?
Yeah, so this is one that's also established by the federal government. So every year they determine what are the caps in terms of total contributions that you can put into this plan. And so be aware that if you over-contribute to the plan, you're going to be subject to a potential penalty for putting too much money into this plan. And another point to keep in mind is if you work for an employer that's also making a contribution to this HSA as a piece of their health plan, then that also is a part of this total. So for 2020, for individuals, you can put $3,550, and then for families, it's $7,100. So that's up a little bit from last year. So it did increase, but those are the caps for contributions. And then if you're age 55 or older, there's a catch-up contribution. So you can add $1,000 more to those limits in order to reach your maximum contribution amount.
A lot of what you say about the HSA, and you've even made this comparison, it sounds a lot like an IRA, but it, in some sense, trumps an IRA. How so?
We think about it in terms of the tax advantages. So sometimes we refer to these HSA accounts that they're like an IRA account on steroids. And it really is similar to all of these qualified plans, like a 401k plan, traditional IRA account. If you're eligible, you get a tax deduction for the amount that you contribute to the plan. Your money grows tax deferred. And then for those retirement plans, you typically pay taxes when you withdraw them in retirement. With an HSA, you're not paying taxes on the money that you contribute. You're not paying taxes on the money that you use for qualified medical expenses. And your earnings are not taxed as well. So it's got a triple tax advantage, right? Pre-tax contributions, earnings non-taxed, and not taxed when you pull it out. So that's a terrific advantage for that. The other thing I'd note about that as well, when you're taking distributions out of this type of plan to pay for expenses, once you hit age 65, you can use that money to pay for health insurance premiums. So it could be copays and deductibles for dental care, vision. It could be Medicare premiums. So if you've saved up money in an HSA account over the years, that money is available to be used for any type of qualified medical expense.
That has been a very informative breakdown of HSAs, health savings accounts. Thank you very much, Al Chingren. This material has been prepared for educational purposes only. It is not intended to provide and should not be relied upon for investment, accounting, legal, or tax advice. Please consult your tax advisor for more detailed information or for advice regarding your individual situation. The opinions expressed are those of American Century Investments and are no guarantee of the future performance of any American Century Investments fund.